Curious about how much you can afford with your current income? In this video, I will show you how to roughly estimate your home affordability using your credit, your income, and your liabilities. Stay tuned. Hi everyone, Lei Villar-Cisneros here, your real estate go-to expert in the Greater Toronto Area. Today, I'm going to show you how debt-to-income ratios affect how much of a home you can afford. Let's dive into it. In the mortgage world, there are two ratios that you need to be aware of. Number one is the gross debt service ratio. So this is basically your housing costs against your gross income. And this ratio should not be over 35%. Now, what are included in the housing costs? So to simplify things, we'll call it PITCH. And P plus I stands for the principal and the interest, also known as your mortgage payment. T stands for your property tax for the property. C stands for your condo fees if you are planning to buy a condo, and we take half of that monthly maintenance. And lastly is the heating cost. So let's take, for example, an annual income of $100,000, just to simplify the math. So if we say that we cannot go over 35% of that, so the maximum that we can budget for is $35,000. We'll take it on a monthly basis, so that will sum up to $2,916 per month. So given that same example, now let's take into consideration your other costs on a monthly basis. So let's say that the house that you're looking for has a property tax of $2,400 a year. So divide that by 12 to get the monthly cost, and that will sum up to $200 per month. Also, let's put in a condo fee. Typically in Toronto is about $500. Now, if the maintenance fee do not include your heating, then you will have to add that. Typical home or condo property will have a heating cost of $85. Given the cost of your tax, your condo fee, and your heating, we should be able to find the maximum mortgage that we can afford with this formula. The heating cost, the condo fee, and the property tax takes a lot from your affordability or from your mortgage. So when you start looking for a house, you have to take into consideration this cost because it will lower your mortgage amount that you can afford. So given $2,916, your monthly income minus the tax of $200 minus half of $500 condo fee, we had $250, and the heating. So you are left with a mortgage of $2,281. Now, how much does that translate to the amount of house that you can afford? In this example, we will use a current mortgage stress test rate, which is set at 5.04. For a typical buyer with a down payment of less than 20%, the maximum amortization allowed is 25 years. So amortization is the number of years to pay off the entire mortgage, given that your interest rate and your payments remains the same. For this example, I am using an interest rate factor table, and if you wanted to have a copy of that, I will give you a link where to download it if you stay up to the very end of this video. Given that 5.04 rate, we will have to pay $584 for every $100,000 of mortgage. Putting all those numbers into our equation, we will see how much house we can afford. And for this example, our house affordability is at $390,580. Now, let's check how your house affordability goes if you are trying to buy a house instead of a condo. But this time, we are taking the condo fee out. If you see, the condo fee plays a high importance when you're choosing a house. So with this one, without the condo fee, we were able to bring up the mortgage payment to $2,631. Let's see how much of a house that will translate into. So it is about $450,000 home. So as you see, it's not that much, right? If you notice, the condo fee in this example is $500, and we were able to bring up our house value to $50,000 to $60,000 without the condo fee. So if you get a pre-approval of, let's say for example, $450,000, normally with this type of calculation, they don't factor in condo fees. Knowing that amount, if you are looking for a condo, so you have to subtract another $50,000 to $60,000 out of that approval amount in order to buy that condo. If you decided and was able to find a house that is about $450,000 for this example, then you wouldn't have an issue. There is another ratio, as I mentioned earlier. So that is what we call total debt service ratio. Whatever was in the GDS or the housing cost, and then add your liabilities, and then divide it by your gross income. So this amount should not exceed 42%. Now let's find the total debt service ratio. As we said, it is the housing cost plus liability. The housing cost is principal plus interest, or what we call mortgage, your property tax, your condo fee, and your heating cost. Now add to that the liabilities, or these are your debt loads. Once you found that out, then divide it by your total gross income, and there you have it, and you will have your total debt service ratio, or we call TDS ratio. Going back to our previous example, and this time we will take the TDS ratio. As we say, it should not be over 42%. If you have 100,000 income, your TDS ratio should not be over $42,000 or $3,500 in a month. Factoring in the monthly cost of $200 per month for your tax and $85 for your heating. In this example, we will put in your debt loads. So let's say that you have a monthly payment of $350 for your car. And if you have a debt load of, let's say for example, $10,000, the minimum monthly payment for that is 3% of the balance. In this example of $10,000 loan, so you will be paying $300 every month for your credit card repayment. So adding that together, we have $650 for your debt load. Let's put all the figures together to find out the mortgage that you can afford. Monthly income of $3,500, tax of $200, we have zero condo fee, $85 heating, and our debt, which is $650. So with this example, our mortgage affordability is $2,565. So as you see, with the same mortgage stress test of 5.04, the same interest rate factor, because we're using 25 years, and now your affordability goes to 439. The debt to income ratio should be not over 35% and 42% respectively. If your credit is below 680 points, then this ratio is a hard stop, meaning you cannot go over this by even 0.001%. Now, this is where your credit plays a big role. So if your credit is 680 and above, then there are some wiggle room with regards to your TDS and your GDS ratio, but not much. To learn more about how much you can afford, please comment below. If you have a question regarding your personal situation, I am licensed in Ontario, and if you are in Canada, all these ratios that we talked about applies. If you have some general questions regarding this topic or any mortgage and real estate questions, feel free to comment below or contact me directly. And I hope that this video is useful for you, and please don't forget to subscribe if you haven't done so, and share it to your family and friends. Thank you so much for watching. Bye for now.